In this short video, we're going to review both Visa Inc. and MasterCard through the lens of our Fast Graphs earnings and price correlated fundamental analyzer software tool. We're going to start here with Visa, and we're going to look at earnings only. The orange line on this chart plots earnings per share since Visa went public in March of 2008. And then our second example is going to look at MasterCard, which went public in 2006, and you're going to see earnings per share went from $3.52 to $7.64 to $9.52 to $11.23 to $14.13 and estimated at $17.12. You can see the earnings growth of MasterCard has been very consistent since it went public. The same can be said for Visa over a shorter period of time. Earnings went from $2.27 to $2.86 to $3.89 to $4.90. At the bottom of the chart, right under the earnings per share numbers, you can see the annual change of growth rate per each year, and you can see it. There was a 21% growth rate from 07 to 8, a 26% growth rate the following year, a 36 and a 26, and all of that led to an average earnings growth rate of 27.1% for Visa. When we look at MasterCard, we see this one big anomalous number here, 117% growth after they first went public, creating a 33% earnings growth. But in order to maybe stabilize this a little bit and look at something more normal, I would drop this chart down. Instead of running it as a 6 calendar year chart, I would drop it down to a 4 calendar year chart so that I cut out those years. And here I would think we have a more normalized earnings growth rate. As you can see, 22.3% is the average of these four numbers here, 25, 18, 26, and 21. So the point so far is that both MasterCard and Visa have generated very strong earnings growth since they went public just a few years ago. Now we're going to add more detail to the charts, and by just clicking these boxes here in our Fast Graphs research tool, we're going to add the normal price earnings ratio, we're going to add the price line, and we're going to add the dividend area to see if these companies pay dividends. By hitting the go button, we now bring in monthly closing stock prices. The blue line represents the normal price earnings ratio. This blue shaded area shows dividends that are paid out of the green shaded area earnings. And what you see by quickly glancing at this chart is that Visa came out and went public in March of 2008. The stock advanced very strongly through May of 2008, and then it fell into kind of a normal level and stayed at about a 23 multiple, which is the normal PE ratio. That's the number attached to this blue line here. And then, as you can see, in calendar year 2010, with the threat of some regulation, Visa stock price then fell precipitously, and it was trading below both its earnings justified value, which is the orange line, and its normal historical price earnings ratio, which is its blue line. So Visa was, clearly on sale. If we look at MasterCard through the same perspective and look at it for this 4-year period, we see that MasterCard also was a stock that the market had been valuing a little higher than it is currently. It did touch its its intrinsic value a time or two, but you can see each time the stock price fell below its historical number, it pretty much moves very quickly back up to it. So when we look at earnings and market price over this time frame here, let's go ahead and expand this out on MasterCard through its entire inception since it's been a public company, and we'll see that MasterCard's stock price has correlated with earnings, although starting with the recession of 2008 when the price was up here ahead of its intrinsic value, it did fall by January of 2009, and it's kind of stayed at a low valuation. And yesterday was a very big day for both of these companies, Wednesday the 28th was a big day for both of these companies. As you can see by going to the estimated earnings and return calculator fast graph, you can see this drop. MasterCard was up 11% on this day, and Visa, on the other hand, when we go down and look at their estimated return earnings calculator, you can see they were up almost 15%. But a couple of points about this is, number one is the stocks were undervalued relative to consensus earnings forecast. There are 32 analysts that are following both Visa and MasterCard that are reporting to First Call. Both of them expect these companies to grow earnings at 20%. So this line is a PEG ratio earnings line that represents a price earnings ratio of 20 or a PEG ratio of 1. And as you can see, even today with a PE ratio of 18.6, Visa is trading slightly below that. And then if we went back to MasterCard and looked at MasterCard, we would find that MasterCard has a very similar picture to Visa in that it's trading slightly below also. So a couple of points we want to make here is, number one, even though we had this big move in the stock price, in one day, 11% on MasterCard and again the 15 on Visa, when you look at it from the perspective of how it relates to their earnings justified valuation, it wasn't such a big deal. But the real point that I'm trying to make here on both of these examples are that these stocks were undervalued based on either historical norms or earnings justified levels, and with a little, bit of risk kind of wrung out by the Federal Reserve announcing a retreat from their original 12-cent interchange fee limit that they proposed last year under the Durbin Amendment. They increased that up to 21 cents, which was very beneficial to both of these stocks, and the prices rose dramatically. A real quick look at the track records of both of these companies I think is worth doing since we're here. If you invested $100,000 in MasterCard on its original public going public in May of 2006, that $100,000 would have grown to $689,000. That's a 42.6% compounded rate of return. The company does pay a dividend. You can see their payout ratio is very low. They did raise their dividend from 9 cents a share in 2006. Then they had that big earnings year and they increased it to 54 cents and then have held it for 60 cents. And we're estimating that they'll probably raise the dividend this year, but maintaining a very low payout ratio, the company ends up throwing off about a 46.4% compounded rate of return. If we take and go back and look at Visa now, we see that Visa, $100,000 in Visa would have only grown to $138,000, but we're only looking at a period here from March of 2008. Now, Visa dramatically outperformed the stock market during this period of time. As you can see, the S&P, actually lost money on a principal basis, but add in a little bit of dividends, and investors received about a 1.5% return. But let's look at that in relationship to its stock price. It came out slightly overvalued. The price was above the line. Of course, it rallied real strong and then fell, and it's undervalued, at its $86.57 closing price on June 29th, 2011. But all that culminated in a compounded rate of return of 10.6%. MasterCard, on the other hand, was slightly undervalued at the beginning period based on its earnings growth rate, which was kind of high here. Remember, because we have this one anomaly year factored in here. But as you can see, MasterCard was actually a little better valued because it came out a year or two earlier than Visa, and consequently we ended up with this extraordinary rate of return. And part of the message we're trying to get across here is that valuation coupled with earnings growth is actually the most important factors that are going to generate long-term rates of return. If valuation is higher than it should be, your long-term return will be less than earnings growth, and if it's lower than if your valuation is lower or at the low level of earnings growth, then it will ultimately be higher. But the point is, valuation and earnings ultimately are the determinants of what your rate of return is going to be. But in both examples, Visa and MasterCard, we get an opportunity to see companies that were undervalued prior to that big increase that they had on Wednesday, June 29th. So the stock market sometimes misprices stocks, and with the Fast Graphs research tool, we have the ability of seeing that in advance. We think both of these are long-term attractive candidates based on 20% earnings growth, although both of them today are probably trading at reasonable valuations relative to that earnings growth. We just looked at MasterCard, now Visa, both forecast to grow at 20% a year. That would imply that the market value of these stocks could rise dramatically over the next 4 or 5 years, assuming that these estimates are correct. And I might also point out that this 20% growth rate is actually lower than the historical growth rate in both examples, so there is some conservatism built in.